Imagine someone gives you two choices. The first promises the chance to double your money in a few months. It's exciting. Everyone's talking about it. Social media is full of success stories. The second is boring. No flashy headlines. No overnight millionaires. No adrenaline. Just slow, steady growth over many years. Now here's the surprising part. If you asked the world's wealthiest, long-term investors, which one they'd choose, many would pick the boring one. Why? Because getting rich isn't usually about finding the most exciting investment. It's about avoiding the mistakes that keep everyone else from building wealth. Think about how most people choose investments. They don't ask, will this still be valuable in 20 years? They ask, what's making people money right now? That's a completely different question. When a stock suddenly jumps, when cryptocurrency dominates the news, when everyone at work starts talking about the same investment, our brains tell us we are missing out. Psychologists call this FOMO, the fear of missing out. It's one of the strongest forces in finance, because nobody wants to feel like everyone else is getting rich without them. But here's what history teaches us. By the time everyone is talking about an investment, many of the biggest gains may already be behind it. Now imagine two investors. Jake spends every evening chasing the next hot trend. One month it's AI stocks, the next it's crypto, then it's meme stocks. He's constantly buying, constantly selling, always searching for the next big winner. Meanwhile, Sarah does something that looks incredibly boring. Every month, she automatically invests into a low-cost, diversified index fund. She doesn't check prices every hour. She doesn't panic during market drops. She simply stays consistent. At first, Jake looks smarter. His stories are exciting. His investments make headlines. Sarah's strategy barely gives her anything to talk about. But fast forward 20 years. Here's why. The stock market has always gone through ups and downs, recessions, market crashes, economic booms, periods of uncertainty. Yet over long periods, diversified US stock market investments have historically trended upward. Even though past performance never guarantees future results, the people who benefited the most weren't usually the ones making the most trades. They were often the ones who simply stayed invested. That's because one of the most powerful forces in finance isn't intelligence. It's time. Think of investing like planting an oak tree. You don't dig it up every week to check if it's growing. You water it, protect it, and let time do the work. Imagine digging it up every few days because another tree looks more exciting. And the picture often changes. Eventually, nothing grows. That's exactly what many investors do with their money. They keep moving it before it has a chance to compound. Here's another mistake people make. They confuse activity with progress. Buying, selling, checking charts, watching financial news all day. It feels productive. But successful investing often rewards patience more than constant action. Sometimes the hardest thing to do is nothing. And that's exactly why it's so difficult. Our brains crave action. Silence feels uncomfortable. But markets don't reward entertainment. They reward discipline. There's a reason many experienced investors don't chase every new opportunity. They know something most beginners don't. Protecting your money is often more important than trying to make extraordinary returns. Because if you lose 50% of your investment, you don't just need a 50% gain to recover. You need a 100% gain just to get back where you started. Avoiding big mistakes can be just as powerful as finding big winners. This doesn't mean exciting investments are always bad. Innovation creates incredible companies. New technologies can transform the world. But building wealth doesn't require predicting the next big thing. For many people, it simply means owning a small piece of many businesses and giving them time to grow. Simple, boring, effective. So why don't more people do it? Because boring doesn't make headlines. Nobody shares a story about earning steady returns for 20 years. But everyone talks about someone who made a fortune overnight. The media celebrates the exceptions. Wealth is usually built by the routine. The next time you hear about the investment everyone is buying, pause before following the crowd. Ask yourself one question. Am I investing because it's a good long-term decision? Or because I'm afraid of missing out? That single question could save you from some of the biggest financial mistakes people make. Because in the end, the richest investors aren't usually the ones chasing excitement. They're the ones who understand that wealth grows quietly, not through constant action, but through patience, discipline, and the courage to embrace what's wonderfully boring.